Pretty good day for the tape, I guess. Your point is looking at IG corporates, right?
That's right. That's right. Yeah. So I focus on investment-grade corporates.
What's the theme here? What's the thesis?
The thesis is that the Fed needs to control inflation, so they have moved very aggressively, very quickly. We've had 5 rate hikes in 6 months. We're now at 0.75% on the Fed funds rate. This is unprecedented kind of move in the federal funds rate, and so the Fed really needs to control inflation. So interest rates are going up, and in that environment, it's been historically very difficult for the Fed to do that without killing growth. And so our baseline is that instead of the Fed allowing rate hikes to flow through the system and have the natural effect that they would have, that they're going to continue raising rates. And so next year we could see a recession for sure, slower economic growth. So what do you do in that environment? Higher credit quality, bigger companies, better balance sheets, stronger business models, and investment-grade corporates.
You think the market understands that right here? I mean, given how flows have been last few weeks?
Well, I think what the market looks at are returns, and the market's been down 18%, the investment-grade corporate market, and again, unprecedented in terms of negative returns, excuse me. So I think flows have been based on what's been going on in terms of the returns in the market.
Right. How about, it was a big weekend where we were starting to look at CDS and the threats of defaults and worrisome headlines.
Sure,
do you think those are accurately reflecting risk right here, or are we spooking ourselves?
Well, I think what I look at, again, is the investment-grade corporate market, and I look at spreads in that market, and I think spreads in that market are fairly compensating investors. They're definitely not as wide as they could be if we are in a recessionary environment. Right now, we get about 150 basis points over the equivalent treasury in that market. But to your point, there have been some specific credits where there's been a lot of volatility.
Right. So, and speaking of which, how do U.S. banks fit into your playbook at this point?
U.S. banks, we like. Very well capitalized. They're more like utility companies at this point. Their capital ratios have actually been brought up recently. And I think the large money center banks like J.P. Morgan, Bank of America are in a very good position, even in an environment with slower growth. And it comes back to really what's going on in their balance sheets.
This is one thing where we're going to be on watch come earnings season to hear them talk about risk, certainly, and reserves. Do you think the picture is going to sound much different than what we're talking about right now, at least with the banks?
Well, the banks, their earnings have already suffered. Last quarter, earnings were very bad with the U.S. banks. Investment banking was down something like 50%. So from a credit investor standpoint, it's a little bit different than what an equity investor is looking at. We're much more concerned with what they're doing on the balance sheets, and the expectation is that earnings are probably not going to be that great. So we would expect more of that going forward. But at the same time, the banks have been shoring up their balance sheets, and I think their balance sheets can really withstand that economic weakness.